Right now, in 2026, there is a window open for you, a window that has never existed before in American history, and a window that will permanently close at midnight on December 31st, 2028. If you have money sitting in a traditional IRA and nobody has told you about this yet, then what I am about to share with you could be the most important financial information you will hear in your entire retirement. Stay with me because I am going to explain this slowly, clearly, and in plain English. No confusing tax language, no overwhelming numbers. Just the truth about what is happening right now and exactly what you need to do before it is too late. Let me start with a woman named Patricia. She is 69 years old, lives in Tennessee, and worked as a school teacher for 32 years. She has a traditional IRA worth about $190,000. She has Social Security coming in every month, a small pension from the school district, and she feels pretty comfortable. She is not rich, but she is stable. What Patricia does not know, and what her financial advisor has never once mentioned to her, is that in 4 years, when she turns 73, the IRS is going to send her a letter. And that letter is going to tell her that she must start withdrawing money from that IRA whether she needs it or not. And every single dollar she is forced to take out is going to be taxed as ordinary income, on top of her Social Security, on top of her pension, all together. And there is nothing she can do about it once that age arrives. That moment is called a required minimum distribution. And for Patricia, it will start at roughly $7,300 a year and grow bigger every single year after that. She will have no choice, no control. The IRS decides how much she takes out and when. But here is what makes Patricia's situation different from every retiree who came before her. She still has time. You still have time. And right now, in 2026, the government has accidentally, or maybe intentionally, created the single best opportunity in history to protect your IRA money from that forced tax situation. And most retirees have no idea it even exists. So let me explain what is actually happening. When you put money into a traditional IRA during your working years, you got a tax break at the time. You did not pay taxes on that money when you put it in. But the IRS has always known they would collect those taxes eventually. That is what required minimum distributions are. The government's way of saying, okay, time to pay us what you owe. But there is another type of account called a Roth IRA. And a Roth IRA works the complete opposite way. You pay the taxes now, up front, when you move money in. And after that, that money grows completely tax-free. You never owe the IRS another dollar on it. And here is the beautiful part. A Roth IRA has no required minimum distributions. The IRS cannot force you to take money out, ever. You control it completely for the rest of your life. The process of moving money from a traditional IRA into a Roth IRA is called a Roth conversion. And normally, doing a Roth conversion means paying a significant tax bill in the year you do it. Which is why most retirees hear about it and say, no thank you, I do not want to pay more taxes. And honestly, in most years, that hesitation made sense. But 2026 is not most years. And that is what I need you to understand. Two things happen at the exact same time that have never happened together before. The first thing is a brand new law. In the summer of 2025, Congress passed what is called the One Big Beautiful Bill Act. And buried inside that law is something called the Senior Bonus Deduction. Here is what that means in simple terms. If you are 65 or older, the government is now allowing you to shield an extra $6,000 of your income from federal taxes, just like that. An extra $6,000 that the IRS cannot touch. And if you are married and both spouses are 65 or older, that doubles $12,000 of extra protection on top of everything else you already get. This is a brand new gift from Congress specifically for seniors. But, and this is critical, it only lasts through 2028. After that, it is gone. Congress has not extended it. It disappears. The second thing that happened is that the same law permanently locked in today's tax rates. Before this bill passed, tax rates were scheduled to go up at the end of 2025. They were going to jump higher automatically. That did not happen. The rates we have right now, today, are now locked in as permanent law, which means when you move money from your traditional IRA into a Roth, you pay tax at today's lower permanent rates. Put those two things together. Lower permanent tax rates plus a brand new extra deduction for seniors that only exists until 2028. That combination has never existed before in American history, and it creates a window, a 4-year window, where you can move your IRA money into tax-free Roth status at the lowest possible cost. After 2028, that extra deduction vanishes. The cost of converting goes back up, and the IRS will still be waiting at 73 to collect on every dollar you left behind in that traditional IRA. Now let me show you what this actually looks like with real numbers, because I want you to see this clearly. Take a married couple, both are 67 years old, they have Social Security income and a small pension. Their combined income before touching the IRA is around $78,000 a year. In 2026, their standard deduction is $32,200. They get an additional senior deduction of $3,300, and now they have the new senior bonus deduction of $12,000 on top of that. Add all of that together, and this couple has $47,500 in total deductions shielding their income before they owe a single federal dollar. That means they can move a meaningful amount from their traditional IRA into a Roth IRA right now, and the senior bonus deduction absorbs much of the tax cost. Money that in any other year, before 2025 or after 2028, would have cost them thousands more in taxes. Over the full 4-year window, a couple in this situation could move up to $48,000 into tax-free Roth status using this deduction alone. $48,000 permanently out of the IRS's reach, gone from the forced withdrawal schedule forever. Now, I have to warn you about 3 things that can go wrong if you try to do this without understanding the rules. Because doing a Roth conversion the wrong way can actually cost you more money than doing nothing. So listen carefully. The first thing to watch is called the phase-out. The new senior bonus deduction starts to shrink once your income crosses $75,000 if you are single, or $150,000 if you are married. If your conversion pushes you above those numbers, you start losing the very deduction you were counting on. You have to know exactly where your income lands before you move a single dollar from your IRA. The second thing to watch involves your Medicare premiums. Medicare looks back 2 years at your income when deciding what to charge you for your health coverage. If your Roth conversion pushes your income above certain levels in 2026, your Medicare premiums in 2028 could jump significantly, not gradually, but in one large step. A mistake here can cost you hundreds of dollars extra every single month in Medicare costs. This is why the size of your conversion matters enormously. The third thing to watch involves your Social Security. If you are already collecting Social Security, a Roth conversion adds to what the IRS calls your provisional income. Push that number too high and suddenly up to 85% of your Social Security benefit becomes taxable income. So your conversion does not just get taxed on its own, it triggers extra taxes on money you were already receiving. The real cost ends up being far higher than your tax bracket would suggest, and most retirees never see it coming until they open their tax return and it is too late. These are not tricks, these are mechanical rules, and the retirees who get this right are the ones who know where those lines are before they convert a single dollar. So here is exactly what I want you to do. Write these steps down. Step 1. Pull out your most recent tax return and find line 11. That number is your starting income. It tells you where you stand before any IRA moves. Step 2, go to irs.gov and look up publication 590B. Use the table inside it to calculate what your required minimum distributions will be at age 73 based on your current IRA balance. That number is what you are trying to shrink before it is locked in forever. Step 3. Confirm that you are claiming the senior bonus deduction. If you are 65 or older, it is $6,000. Both spouses 65 or older, it is $12,000. It is claimed on Schedule A attached to your Form 1040. Many retirees who already filed their 2025 return missed this completely because nobody told them it existed. If that is you, talk to a tax professional about filing an amended return right away. Step 4. Before you convert anything, identify your 3 limits. The senior bonus phase-out at $75,000 for singles and $150,000 for married couples. The Medicare income threshold at $106,000 for singles and $212,000 for married couples. And the Social Security taxation threshold at $34,000 for singles and $44,000 for married couples. Your conversion must stay below whichever line you hit first. Step 5. When you do convert, pay the taxes from money outside the IRA, not from the IRA itself. If you pull taxes out of the IRA, that is money that never makes it into the Roth and never grows tax-free. Pay from savings or a checking account Every dollar converted should land fully inside the Roth from day one. Step 6. Work with a tax professional who specifically understands the 2025 tax law changes. Ask them directly about the senior bonus deduction and how it interacts with Medicare and Social Security. If they are not familiar with how those three things work together in 2026, find someone who is. This is too important to trust to someone who is not kept up. Step 7. Do not wait until December. Most people do conversions at year-end when they have the least information and the least room to correct mistakes. The best conversions happen in the middle of the year when you have real income data and time to adjust if needed. For those of you who are caring for a parent or a spouse, please share this video with them today. Print out these 7 steps and sit down together. So many seniors are sitting on traditional IRAs that are quietly growing into a future tax burden they do not even know is coming. You have the power to help someone you love protect their retirement right now while this window is still open. Here's what I need you to hear before you close this video. Patricia, the teacher from Tennessee, she still has time. She has 2026. She has 2027. She has 2028. 3 tax years where this window is still open. 3 years to protect her IRA from forced withdrawals. 3 years to move her money into tax-free safety on her terms, not the IRS's terms. But after December 31st, 2028, the senior bonus deduction disappears, the extra room it created disappears with it, and the IRS will still be there at 73, sending letters, setting schedules, collecting taxes on every dollar left sitting in that traditional IRA. You worked too hard for this money to let a closing window take it from you. You saved for decades. You sacrificed. You planned. And right now, the government has, perhaps for the first and last time, given seniors a real advantage, a real opportunity to protect what you built. Do not let it close without taking action. Check your IRA balance this week. Find your tax return. Call a qualified tax professional because the clock on this window is already running. And when it closes in 2028, it will not open again. This channel exists to make sure you never miss information like this. If this video helped you understand something important, please hit the like button right now and share it with someone who has a traditional IRA. They need to see this before 2028. And subscribe so you never miss what is coming next. Because there is a lot more your retirement deserves to know.